So if Judy buys a house and she puts 3 grand down on her $100,000 house and gets a mortgage for 97,000, but she misses her first month payment, misses it, like goes more than 30 days behind, that value of that note has dropped. It's no longer really worth 97. It's worth 95% of that 97, maybe 90 cents of the dollar, depending on how it's the interest rate or what her FICO was. Okay. So it loses 5 to 10% every month that she's late. Well, now in most of these mortgage companies that are out there, these mortgage brokers, if they're Judy's stop paying in the first 6 months, they've got to buy that note back at full value. So now they've got to buy back that $97,000 mortgage, which is maybe only worth 92 now because of value, right? So this is why banks are very aggressive on the outreach when you're falling behind. That's why you get certified letters, your phones, they're sending up, they're calling your job, all that kind of stuff, because they don't want that to default. They don't want to buy that stuff back. Okay. Now you'll also have a product that they're called scratch and dent loans, where it's sometimes newly originated. Maybe Judy's fine, but maybe right before closing, she went out to Rooms to Go and got a line of credit to buy new furniture for her new house, right? And her credit score dropped from, say, 680 to 650. Well, the lender closes the deal, and then when they go to sell it, the bank that's going to buy it looks at everything and say, "Oh no, Judy's credit score is no longer 680; it's at 650. We only want to buy at 680." So now that lender is forced to shop that loan around to other places, and it's kind of called a scratch and dent loan. I mean, there's an issue with it, but it's not really an issue too difficult in one case. Now you see scratch and dent loans where borrowers got laid off before closing, or they didn't have the 2 years of continuous work history, their credit score is down, maybe they got an FHA loan and it wasn't their primary house, somebody didn't do their job. So you have the scratch and dent loans. Doesn't mean it's bad paper, but they necessarily don't want to sell it to you at a discount. So I don't buy scratch and dent loans because you're not going to get a big discount. At 90, 80 cents on the dollar, it's still not a really good deal for us, depending on what the interest rate is. So like, especially you have a lot of these loans floating around. There was a post on LinkedIn from one of my buddies yesterday. He got a portfolio of loans that were written at 2.53% interest now, which is great. It's a great interest rate of your borrower. It is not a great interest of your bank, because they've got all this money tied up in 2.5% loans. It's not paying them hardly anything. For them to sell it off to somebody like me, I want 8 to 10%. So if I want to get 10% on a 2.5% performing loan, what am I going to offer?